Okay, today we're going to be looking at how we go about doing a 5-year financial analysis of an apartment building or a rental that we're thinking about buying. The interesting thing today, though, is we're going to use an actual example of one I wrote 4 years ago this month for some clients who were looking at townhouses. Stay tuned and we'll show you how it works. So the first thing that we'll do, just to set the scene for what's going on here, is we'll go over what the properties are, just in broad details. So as I mentioned, there were townhouses, there were new construction, kind of cookie cutter, 1,200 square feet, 3-bed, 1.5 bath, unfinished basement, and single car garage. Now, the purchase price was $400,000. The down payment, we're going to be putting 20 points down, so that's $80,000. So we're left with a mortgage of $320,000. Monthly payments, now keep in mind this is 2019, right? So we had monthly payments at 3.29 with a 30-year amortization, which gave us an annual debt service. That's the word we use for all the mortgages that you pay over the course of a year. Annual debt service of $16,749.24. Now, before we go any further, there are two key concepts that you need to understand when you're doing a financial analysis. There are two ways that you make money. Number one is cash flow. Now, cash flow is cash flow. I don't know how better to explain that. It's simply all the money in, all the money out before taxes. So look at your bank account, that's your cash flow. Second thing is appreciation and equity. So appreciation is the word that we use for how much has your building increased in value. And equity, this is key, equity is the word that we use for what share or what is the value that you own of the building. For example, when you purchase a building, you're putting 20% down. You have 20% equity. The bank has the other 80%. So over the years, as you pay down, the building gets more and more valuable, it appreciates, your equity grows. So remember, cash flow, appreciation, and equity. All right, let's start off with the easy one, cash flow. So it's money in, money out before taxes, right? So what's the revenue? The builder was actually guaranteeing this for a year at $1,700 a month, which I felt was fair. If anything, it was perhaps a little bit light, maybe $1,750, $1,800. But for our purposes, we're going to be conservative with the rental income. So $1,700 a month per townhouse, $20,400 into your bank account every year. All right, next we have the expenses and net operating income. So I'm looking at this, just a little aside. As soon as I see hydro, heat, water, and sewer paid by the tenant, I love it, right? The less the landlord is responsible for, the better. Now, you don't need me to go over this. Suffice to say, at the end of the year, the landlord's expenses before finance would be $6,862. So money in, money out. We're left now with a net operating income of $13,538. Now, we're not just interested in this here. We're going to be owning this building for quite some time. So typically what I do is a 5-year projection. So let's take all those expenses, all that revenue, and what we're going to do is we're going to punch it out 5 years and see. So up on the screen right now, you're going to notice immediately that these numbers change. Well, we have inflation. Keep in mind, this was prior to the pandemic. If you're asking me today what the inflation rate is going to be over the next 5 years, I'm going to scratch my head. Back then, 2%, close to the Bank of Canada target, if not the target. That was a fairly good number to plug in there. So we've used that for the rental income, and we've also used it for the expenses. So again, we're not going to go over all of these, but you can see year one, we've got that net income. But if we go to year 5, we see the rent's gone up, we've seen our expenses go up, but our net income before finance is going up. So that's good news. That's what we want. Okay, so we've modeled revenue for 5 years. We've modeled expenses before finance for 5 years. Now we have to plug in this mortgage, right? Now you recall from the beginning of this that we had an annual debt service of $16,749.24. That does not change, because we've got a 5-year fixed mortgage. That mortgage amount is going to stay the same. Everything around it, though, is changing with inflation. Your revenue is going up, your expenses are going up, but that stays constant. All right, let's look at year 1. Now, I forgot to put year 1, 2, 3, 4, 5, but you can figure this out, right? So the net income before finance, year 1, $14,000 change. Then we pay $16,000 and change to the bank. So our net income after finance is minus $2,191. So imagine this, you come up to your spouse and say, hey, I've got this great investment. We're going to put $80,000 and every year we get a check back. Well, in the first year, you don't get a check back, you get a bill. So you are making, in terms of cash flow, minus $2,191. 2 points to make. Zipping over to year 5, we do see that that cash flow or the expense, the check that we're writing at the end of every year is cut in half. So that's good. We want it in that direction. Eventually, the goal is to have it cash flowing, right? But okay, so that's a good piece of information there. The second thing, and this is critical, this is where this equity business comes in. Let's look at year 1. So year 1, you paid $10,000 in interest. That goes to the bank. It's gone. There's perhaps a little tax benefit there, but we're going to forget about that. That money's out the door. You're not seeing it. But look at this. We've got $6,387 in principal paid. That's yours now. So the tenant has been paying you. You're paying the bank, and you now have received $6,387. Okay, so that's that little teaser for what we're going to see right now. Okay, so up on the screen, let's see what this stuff means. EOY, by the way, means end of year. So we've got an end of year mortgage balance, right? So we've owned it for 365 days of $313,000. Remember, we started at $320,000. So that has been paid down. Now, here's the other thing. Look at the second line. End of year asset value, 5% annual. So just like with the expenses, we had to estimate what inflation was going to be for rent and hydro, everything like that. We also need to guess, or estimate rather, what the inflation rate or appreciation rate is going to be for the real estate. So we put 5% there, which at the time was reasonable and fair, in my opinion. So that building started off at the beginning of the year worth $400,000. It's now worth $420,000. So let's stop. We've got the tenant paying principal down of that $6,000 odd, and then the real estate gods have just given you $20,000. Right, in appreciation. So you bought it in 2019, July 2019. By July 2020, you're sitting in the basement watching Netflix wondering what COVID is, and you have got an additional $26,387 from the principal and the equity. But hang on, you also had to write that check for $2,000 odd, right? So we have to subtract that. So bottom line, annual return, equity, principal paid down, appreciation, plus your retained earnings. Well, your retained earnings were minus $2,000. But here's a very important example for people to understand. Just because you're cash flowing negative does not mean that you're losing money. In fact, the people who bought these townhouses made $24,196, and then if we punch that forward, at the end of the 5th year, it was $30,597. Okay, so very, very good deal, in my opinion. Now, the final part of the analysis is to look at something called cash on cash, as well as the return on investment. So let's take a look at both of these. Cash on cash return is a rate of return ratio, so it's something divided by something else, that calculates the total cash earned on the total cash invested in a deal. The total cash earned, cash flow, divided by what you've put in there in terms of cash, right? The $80,000. It is defined as cash flow before tax, but after finance. Remember, we're ignoring tax, but not the bank, in a given period, 1 year, divided by the equity, what do we put in? Invested at the end of that period. The second metric that we're going to look at is something called return on investment. It's also referred to as ROI sometimes. So up on the screen, we're going to take a look here. Return on investment, ROI, measures the profit you have made or could have made if you sold on an investment. Okay, again, measures the profit you have made or could have made if you were to sell on an investment. ROI is calculated by comparing the amount you have invested in the property including the initial purchase price, plus any further cost to its current value. All right? So it's a little bit different from the cash on cash. Don't worry if this is kind of, what the heck's this guy talking about? We're going to look at some examples that'll make it clear right now. Okay, up on the screen right now, return on investment, ROI, and cash on cash. End of year purchase cost is $80,000 plus LL subsidy, landlord. LL is the term that we use, whatever, for landlord. Now, I call it a subsidy. It should be retained earnings, but again, we're writing a check each of these 5 years, so let's call it what it is. It's a subsidy. All right, so your outlay in year one is $82,191. What was your cash flow? It was minus 2,000 some odd dollars. Okay, so your cash on cash return is minus 2.67%. That is absolutely horrible if it's the end of the story, which is not. Again, as we noted previously, we do want that cash flow positive at some point, please. So we do see it as we're going through year 1, 2, 3, 4, 5, where it's almost it's less than half as bad as it was in year one. Okay, again, if that was the end of the story, you do not buy this building. But we've got a tenant who's paying your principal, your equity is growing. We've got a building that is appreciating. And we liked this building because it was in a town, an area, good employment, good rental income, good demand coming. And we were correct in this, by the way. So that appreciation, the building's getting more value. So if we look at what we put in, $82,191, divided by what the building, what our retained, what our equity and retained earnings and the appreciation, that's a 29.44% return. That is excellent. And as we see, that just goes up and up through the years, ending year 5 at 34.78%. Now, let's take a look at what actually happened. Old Einstein over here wrote this up, as I mentioned, 4 years ago this month. Okay, so up on the screen, what actually happened after 4 years? Remember, we did this for 5, but we're at year 4 now. So I said that the asset value with appreciation would be worth $486,000. Well, 2 of the buildings have sold this year, and 1 is pending, so it's within the last few weeks. $649,000 was that last sale. So I was off, thankfully, by $162,000. Now, we went through COVID. I did not anticipate a land war in Europe, a worldwide pandemic, and all the other shenanigans that have been going on. But again, that's great for that buyer. Now, the second thing, the rental income. So I had said at the end of year 4 with the 2% jumps that would be at $21,648. 2 of the units have rented since January, within the last 5 months. And their average was $28,200. So I was off in the right direction by $6,551. Now, that one's a little bit odd in that had the tenant stayed in there for a full 5 years, under our assumptions, we would be around that $21,000. But you know, if we had turnover, ran into some good luck with some tenants moving out, the rent would have been $6,500 more. Okay, so I appreciate you watching until the end. As always, if you have a building to sell you're interested in buying, I want to hear from you. My email, my cell phone will be in the description below. Again, thank you for watching. We'll talk soon.